Hello and welcome back to another episode of the Collective Clicks podcast. This is your host, Brandon Bateman, and today I'm joined by Fouad Bazzi. Fouad has been doing a lot of pretty cool stuff in the short-term rental space, and we talk all about how that can fit into the real estate investment portfolio, not just as real estate, but even building a business on top of that real estate. I'll see you there. Fouad, welcome to the podcast. We're happy to have you here.
Thank you so much. Excited to be here. Thanks for having me.
Yeah, for anybody listening to this that doesn't know you or about you, what you do, what's the summary?
So summary, spent 20 years in corporate America, consulting, all in banking. Mostly for the last 12 years, I was consulting banks, and I was traveling all over the country doing that. And about 13 weeks out of the year, I was on the road. And so 2019, when my wife was pregnant with our third, it was, well, a couple things happened. 2019, we were pregnant with our third, hit all of our financial goals at the time. And then real important one, she's an attorney and she has her own practice. So her income actually outpaced mine at that point. So it was like, so when all those things aligned, we knew that was our goal, that I could leave corporate and start my entrepreneurial journey, basically saying that, if I fail miserably as an entrepreneur, the world will always need another banker. So I could always go back if I needed to. It was a great insurance policy. And luckily, we're 6 years in, and so far I've made it. So that was that. So I left corporate America 2019, got entrepreneurial, started a chain of coffee shops with kids play places inside of them. COVID punched us in the face, had to close all those down, and I had some long-term rentals that we were deploying our capital into without a strategy. I didn't know anything about real estate other than just like what everybody tells you, you get wealthy buying real estate. So I was just buying real estate. And I didn't like those because I'm way too nice and I couldn't kick anybody out that wasn't paying us any money. And so then we kind of did the short-term rental space because we had to. So my daughter, when she was one, we found out she had severe food allergies, and we live in Detroit, Michigan. And the best food allergist in the world is in Long Beach, California. So we get her into this program, and when they draw her blood work and like set up her custom like program, it was, hey, for the next 3 years, every 6 weeks, you guys have got to be here for a couple of days. And so I was like, okay, cool. Let's just buy a house in Huntington Beach, put it on Airbnb when we're not there, but we have a place to use while we're there, right? So did that, but I said, if you're going to do this, there's no reason to do it small. So we bought one in Huntington Beach and two in Scottsdale at the same time. Fell in love with it, started scaling it, realized that we're going to run out of money really quickly if we kept doing that. So started raising capital, and we scaled it. So we're at 11 owned right now, 2 more that we're building. So we'll be at 13, and I started a management company. Well, I acquired a management company about 9 months ago, and I kept the owner of that company on as my director of operations. And we're at about 95. When I acquired her 9 months ago, we had 60 properties. We're at about 95 now.
All right. Very cool. Good for you. That's a lot. I'm curious, when you were in the banking world, you said you were consulting with banks. Like, what kind of consulting?
So we competed with the Federal Reserve, and what we did is we kind of acted as an infrastructure for community banks. And so, if you think about like the 4 payment methods in the country, there's wire transfer, ACH, check, and credit card. And the community banks, well, all banks, they have rails through the Federal Reserve, and Federal Reserve is like the clearinghouse for the world, right? And so what we did is we basically kind of partnered with like the other top 29 banks. I worked for a bank, and our company, and then 29 other banks, we all partnered and said, let's minimize the relevance of the Federal Reserve. Let's create direct clearing with all of us, with each other, and not have to clear through the Federal Reserve. So we opened up our railways to community banks to join us, minimize their cost. I mean, we're talking about them clearing checks with us at mills. Mills are fractions of pennies, right? And so, I mean, but you're talking millions of items, and then we ran their wire transfer for them, ACH, all that. But then we would, do some executive consulting. We would do some disaster recovery stuff. We funded merger and acquisition, consulted through merger and acquisition. It was a lot of fun. It was probably the funnest job in banking. I mean, I spent 70% of my time with the C-suite of community banks and golf courses and sports stadiums. So it was a tough job to leave. It was a lot of fun. I mean, our philosophy was basically, I get the C-suite in a boardroom for an hour, I get them in a golf cart for 4 hours. Which one are you going to take, right? So we kind of had an unlimited golf budget. And, so I used to play like 100 rounds of golf a year, and I left corporate. Now I play like 8.
Oh, that's so funny. Yeah, I'm always so curious just because it seems like a lot of people in the industry kind of bring a unique approach to what they do just based on what their background was before. I'm always so curious because I myself, I did nothing like before I had this business. I started this business as a sophomore in college. So my background, I mean, this was like literally nothing. Like I've learned everything I've learned, like doing what I'm doing now. And I'm always, I'm like always slightly envious of people like you and like, like you actually knew something about business before you had your thing. Helped a lot, but I imagine it's the world's different.
It is. And you know, because it's like the grass is always greener, right? So, you know, from my perspective, I was 37 when I left corporate America. And I'm like, I look back and I say, man, I was 16 years late. Like people
Yeah.
told me when I was really young, get into real estate, get into real estate, get into real estate. I had multiple opportunities to go start at an agency when I was young and no dependents, not married, right? Like, so I could take all the risks in the world. And looking back, I wish I kind of would have, but also, yeah, and I wouldn't have known today what I know. I understand creative finance really well. I understand deal structuring really well. I understand raising capital really well. I understand so much because of my days in corporate, especially in banking, right? So where numbers live and die. So, you know, I think there's value in every journey. It's just about what you make of it on the back end. So right now I'm just, you know, I'm living like a rookie and learning as I go. But I feel pretty good about where we've come in a pretty short amount of time.
Yeah, that's really cool. So tell me, I want to understand this like unique flair that you're adding to this. So with these lessons that you learned from that, like you mentioned a few things like you understand deal structures and raising capital and creative finance on a different level. What are sort of things that like help me understand how that's actually impacted you already? Give me examples of things that you're doing maybe on a on-to-month basis that when you look at what other investors are doing, like if they understood this better, then they'd be able to do it on a higher level.
Yeah, well, I mean, I'll tell you what. I mean, and we met in the boardroom mastermind, right? And that's why I'm wearing this hat. Actually, it's not why I'm wearing this hat. I'm wearing this hat because I shaved my head and it's been like 2 days. So I feel like I look like a chia pet right now. So I'm just kind of wearing the hat to cover up the fuzz. But so we met in that group and that's founded by Kent Cloutier. And Kent said something to me. When I was vetting the mastermind, I paid the $10,000 to go spend a day with Kent. And I wanted to see, you know, what is this about? If I'm going to spend 30,000 to be in a room for, you know, for a year, like what am I really getting myself into? Who is this guy and who's he around and all that stuff, right? So he said something to me at the time. I owned 3 short-term rentals and I walked in, a couple of things that he told me. One, he was the one that basically tipped me off on OPM, other people's money. And it was, you know, look, it's nice that you bought 3 of them, but I don't care how much money you have. You're going to run out of money really quickly if you just keep buying, you know, more than $1 million homes. And so put on your finance cap. If you were a banker, go raise capital because you can always run out of your own money, but you can't run out of other people's money. Right. And that's what I leaned into my merger and acquisition. And when we used to look back and think about a capital stack on an M&A deal in banking, you know, there was shareholders, there was stock, there was cash, there was financing, there was multiple layers. So we had to get creative in the banking space to help our clients acquire other potential clients as well. And so that's really translated well here. On the buy side, when we want to acquire, we're always, the way I always acquire is and by the way, I've acquired nothing yet on seller finance, but we use it as a tool on every deal that we make because it's, hey, look, I'd love to offer you your price and your terms and all that. And here's what it would look like on a creative deal. But if you really want to do this traditionally, here's what it's going to look like. And it's usually at a larger discount. So it always works because they look at the creative deal and they say, well, if I want my money, then I got to stay as a lender and I'm going to get all my, I'm not going to get it all now. I'm going to have to wait for it. So we'll just take that discount instead and we'll just go ahead and sell it to you on clearance. So it's worked out really well for us being able to get creative there. It's also worked for us on structuring our deals with our investors, understanding that there are multiple levers and it doesn't always have to be one size fits all. So I'm not launching and raising funds right now. If you're doing that, obviously everything is very uniform, right? From one investor to the next. It's, here's your minimum buy-in and here's how many shares you get and all that, right? That's how a fund works. The way we raise our capital is it's usually one investor per deal. We got a couple where we've had 2 investors, but usually it's one. And understanding that, there's the equity at play, there's the cash flow that comes from the deal, and then there's the cost aggregation study benefits. And so, we always start at like 50-50. Hey, you bring the capital, I'm sweat equity, and we just split everything 50-50. Now we might have an investor that's good with that. We might have an investor that says, hey, look, like our most recent deal, our investor makes $35 million a year. All he needs is $8 million worth of buy and holds every year to offset his nuggets, his tax nuggets. So it's like, okay, cool. So how do we do that? We're going to be 50-50 equity, but I get 100% of any cash flow that we make on the property while we're operating it as an Airbnb. And you get 100% of the cost segregation study, right? So it's just understanding that there are multiple levers to pull to make a deal. And again, it happens with investors, happens with buyers and sellers, happens at every layer. I would say that's probably the most important one that translated from the banking space into real estate.
Yeah, that's really fascinating. And I can tell you, I don't know a lot of people in the real estate investing space that focus a lot on short-term rentals. It's definitely the niche that you carved out a little bit. And I know they're out there. They're just, less, I guess in the circles we're in, they're doing a lot of direct to seller marketing and all that stuff. And it's a little bit less common. What would you say to, let's just say like the average person who listens to this podcast, where they're probably doing, in most cases, a lot of wholesale deals, they might be doing some fix and flips, probably have at least a yield, sometimes 20 or 50 long-term rentals, and they're familiar with that space. Or that person, based on what you know about short-term rentals, is it a distraction, or is it something where you feel like they could add significant value to the business that is already around being too much?
I think it depends on what their goals are and where they are in their investing career, right? Like how deep are they? So if it's, if they're, here's the truth. The truth is if you go on Instagram and you find all the short-term rental gurus, right? The online gurus that tell you that all you need is a cell phone and a beach and a martini, and that's how you can live your life as a short-term rental host. They're absolutely lying and they have no idea what they're talking about, right? Like being a short-term rental host or manager is a full-time job. Now, I know for sure I don't want to be the guy that's sitting here answering Airbnb messages. Like that's just not where I want to play. So I've got a really good infrastructure, really good team around me. And then I've got a great integrator. I get to play the visionary role. So that works really well for us. Here's what I will say. There's a couple really good reasons to buy a short-term rental. One, it's a great lifestyle asset, right? You grow in a family, you do run a real estate business, and most of the time you can do that remotely, all of those things. Well, let's take the family, let's go on vacation, let's go to our mountain house, our cabin, our vacation home on the beach, or wherever it might be, and let's hang out. Kids can play, wife can do what what you want, or husband, it doesn't matter. And I can get my job done from here and enjoy it as a lifestyle asset. And then when I'm not enjoying it, I can rent it out, right? Like, great. That's incredible. That works awesome. The other way that it works really good as an investment is if you're not yet a real estate professional, but if you've been listening to all the stuff going on with BBB, the big beautiful bill, and all that stuff, 100% depreciation is back. And if you're not a real estate professional, I don't want to call it a loophole because to me loopholes sound like they're not good. These are actually just parts of the tax code. These are parts of the tax law that if you're not a real estate professional, a short-term rental still does qualify you to allow you to bring bonus depreciation home. And the reason it does that, it is, long-term rental, things like that. Those are passive investments. And so those passive investments you can't use against your active income, right? But a short-term rental does not count as passive. It counts as active because it is active. Now, there are things and criteria that you have to meet in order for it to qualify as a active real estate investment. But we work with the owners of the properties and we know how to help them get it set up that way. And then we can still do the managing for them. And so this allows them to depreciate against their W-2 active income, still use it as a lifestyle asset, keep all the money that they make. So a lot of times I think, people say, well, how do I go make more money? How do I make more money? How do I make more money? I say, first, you should focus on keeping the money that you make. And the short-term rental space allows you to do that.
Yeah, it's definitely fascinating. I'm going to put a comment into the discussion from like a short-term rental naysayer. And I want to hear how you beat it at. I'm playing devil's advocate just because I want to hear like all angles of this. So I was talking to someone, maybe someone we both know, I don't know. And what he told me is like, yeah, I looked at that stuff and I tried to pencil like the whole short-term rental as a lifestyle asset thing. And I realized I'd be better off putting my money into long-term rentals and then just renting a house, these places when I want to use it. And I know every property is different. Like what long-term rental, what market, what short-term rental, what's what's the cash flow going to look like? How often are you going to use it? Like all these kinds of things. But how do you think about like that trade-off? Because I have heard of a lot of people wanting, like it's an attractive asset class because of that, because of the fact that like people want short-term rentals for themselves, right? They want second properties and stuff like that, but they don't want to, have to deal with the full cost of having that second property. But I've heard it compared to like sports teams, for example, which is as you look at like business assets are some of the most overvalued. The reason being, of all the business assets you could have, like how many people want a sports team compared to some lame thing that like isn't actually as cool as a sports team? Like tons of people want it, right? So it becomes an overvalued asset. How do you feel about that in the short-term rental space?
I totally get that, right? Like I think what happened is over, through COVID, the short-term rental space became anything can go as an Airbnb. House next door in the neighborhood, the house behind us, no experience, just typical 3-bedroom, 2-bathroom, has a swimming pool or a hot tub, and we just need places to go. The problem with that is for decades, we've known why people like to travel, and it's camp, hike, and swim. And swimming, I'm talking about lakes, oceans, things like that. We've known that for decades. That is the top 3 reasons that tourists travel. And so, you know, when COVID kind of like expired and people can get on planes again, go to all their favorite destinations all over the world again, places that blew up during COVID, like Broken Bow, Oklahoma. There was this huge, like, people were like buying properties in Broken Bow, Oklahoma. And I was like, why are you doing that? That's ridiculous. No, there's no job growth. There's no wage growth. There's no population growth. There's no infrastructure growth. People are only going there right now because they can't go to their favorite destinations. It's not going to last forever, right? And so the people hurting in the short-term rental space are people that were considering investing in markets that really just, it doesn't make sense. They're not true vacation markets. And so what I would say is this is still very much a real estate investment. Like at its core, number one, it's a real estate investment, right? So the one we're launching as we speak, we're building this one. We bought this house. It's in one of the nicest neighborhoods in Phoenix, Arizona. We bought this really, really old home, tore it down, rebuilt. We're like withholding costs and everything. We're like 1.65 all in, but we appraised at 2.3. And so it's like, that makes sense. We can break even on this thing and we don't even care because we've got our money out on the refi. So we still get to use it as a long-term asset or as a lifestyle asset. Sorry, we get to use it as a lifestyle asset. We get to hold it. If it completely flops and it's not covering our bills and we're having to interject equity, we'll sell it. And we've got plenty of equity in there, right? So we approach everything first still as a real estate investment. And again, those 3 KPIs are 3 things that I love to follow: population growth, wage growth, job growth. I'm really high in the valley in Arizona. I think it's a really great time to be there. Just everything that's going on, all the technology that's blowing up there, all the outside investments that are coming in, the businesses that are moving there, the inflow from California, from the wildfires and the government and people just kind of really wanting a different environment. It's just a really, really good time. So again, infrastructure growth, job growth, wage growth, population growth. Those are things that I'm really looking at. And that is happening at a really rapid pace in Phoenix. So when all those things line up, again, we're creating so much equity in our projects that we're just comfortable buying and holding there.
Yeah, it makes a lot of sense. Very cool to hear your perspective on it. What do you feel? Let's talk about the management of it. Like you said, anything but passive. Like I view like Airbnbs as, I guess, more similar to a hotel than they are to a long-term rental, in the sense that like a hotel's a business. Hotel's business isn't just real estate. Like it's an actual business.
Yeah.
Like if we're looking at my business, like the real estate investment returns, you'd be looking at like how much space in an office we take up versus food income. You'd be like, it's the best real estate investment ever. But it's the business that's revenue, not like the real estate. And Airbnb is a little bit like that. Curious what you've seen from the management company perspective in terms of like how much does it really take and what are people's options? Are there actually good management companies? I think like my first year would be, I'm going to have to write the word like recently, or have to give it to a management company. And if I give it to a management company, it'll just launch the performance and you're not going to do that. I want to do it myself. And I can't trust them. I trust them.
Yeah. That's a great question. First of all, I mean, why I love it is it's exactly why I love it. I get to build a business on top of my real estate. I can exit the business and still keep the portfolio, right? Like, I mean, that's really attractive to me. We are already talking to private equity about how do we, what are our goals? How do we reverse engineer that? What do we got to build to in order to make an exit on the business itself? Now, will I ever actually exit it? I don't know. My kids are 10, 9, and 6. I really do want them to take this over, make it bigger. I want this to be theirs. I don't really care, times are changing, generations are changing. I really don't care if my kids go to college. I definitely care that they learn, whether it's through other entrepreneurs, masterminds, but I do want my kids to be entrepreneurs. I mean, that is something that I really hope for. Now, if they're passionate about going and being a tax strategist or an attorney or a doctor or something like that, cool. Like if they're passionate, right? Not just for money, because money, go run a business, go figure it out. But so that's one of the most attractive parts of it to me is we do get to build a business on top of it, right? As far as like, yeah, I mean, there's just like in any industry, like in the restaurant industry, you're gonna have some that are really good, and then you're gonna have some that are like, look at these people, they just started a restaurant, and they turn it over to employees, they don't even manage it, it's not good anymore. Like, how many restaurants do you know that you tried in the first 90 days were freaking fantastic? You went back 6 months later, and it was like, oh, they totally let it go. It was just a one-time thing, right? And so their management companies are very similar to that, I would say. Hospitality companies are very similar to that. You look at Vacasa. Vacasa was one of the biggest in the world. They had a crazy valuation, public valuation, all of it. It was wild. And they ended up taking a beating in the market because they just got super mediocre, way too big, way too fast. And they ended up selling to Casago, maybe about a year ago, right? So no doubt you have to be intentional about your growth. Like any business, it still has to maintain quality as you grow. So we're very intentional about, right now we're in 6 markets between our 95 properties. We've got a really, really good infrastructure. We know how to launch a new market. We're not excited about launching more in new markets, but we are. I mean, still, when the opportunities are right, we will. So like we're going into the mountains of Georgia as we speak. We have an investor there that's giving us 6 homes all at once. And I think that's great. We'll take that because we definitely don't want to go to a new market because of one property, but we'll go for a handful. And on top of that, we have a couple of resources there that are going to become kind of like sales referrals for us. So they'll bring us more referrals. And because the goal is if we get in the market, we'd like to get to like 20 to 25 there, right? So that's the ultimate, that's our focus is is it a market that's scalable? Is it something that we know year after year after year, even pre-COVID? We got to make sure pre-COVID, this was an attractive market. People wanted to travel here. Look, does that mean we're perfect? When I say all this stuff, does it mean we're perfect? No. I mean, look, we bought some that we have not been able to distribute profits on, right? Like, I mean, so just like anything, if you open 13 pizza shops, one's going to be your best and one's going to be your least. I mean, like it's just the way it works. The more locations you open of anything. And so, but that's our approach. I mean, that's kind of how we're going, but we're very, very cautious right now about where do we open, where do we go, and how do we get there?
Yeah, it's really, really interesting that you view it as like the business on top of the real estate.
Yeah.
Because I've heard, it seems like most people I know that are in property management for some type, either one is to like manage their own portfolio. Like I know people with 300 doors that have like their own little property management company. That makes sense. Or they're just trying to exit it one day.
Yep.
Because property management companies, they seem to have a lot of buyers after them. They sell for decent multiples, compared to like a real estate business or something where, you have a little bit of a hard time exiting that kind of business.
There really are. There are really good multiples. I network with a lot of people that are doing the same thing as we are. And so the idea there is, if we all scale and we all get together, we always hear the thing, right? Competition happens at the bottom, collaboration at the top. So I collaborate with a lot of people that even in the same markets as me. We're trying to all build, and the faster we build, and then the quicker we can then put our balance sheets all together and then go make one big exit. I mean, there's a lot more cash flow in this space. So there's a multiple exit that can be made. Again, will we ever do it? I don't know, but it's definitely an option.
Yeah. Well, it's interesting that like the number one thing you think about when you're considering that versus not is your kids.
Yeah.
That's like the number one. That's not what I would expect somebody to say.
Mike, so our kids are 10, 9, and 6. Last week, we spent it in Arizona, and we were there because this house is done, and then we're launching 3 others that are managed properties. And so they got to go around, they got to see why we were there. They do put their hands in it a little bit. I give them especially like when we're staging and designing one of the homes, we order the same books, same toys, same, like there are certain things on an Amazon list that we order at every single one of our homes. So it's like, hey guys, here's the toys, here's this, here's that. Take these ones to this room and just go design it, right? So I make sure that they're getting their hands in it. They really understand what we're doing. We stay in the homes, and so they feel it, they understand it, right? And it all becomes part of an ecosystem of learning for them while it's a lot of fun. So again, lifestyle assets, check. Learning, check. Training them to be entrepreneurs, check. I mean, it's all there. It's all integrated, and we're very intentional about how we do that.
Oh, that's what's cool about real estate. It's like tangible, even for like a little kid, they can see it. I don't know what to like give my daughters. Like they can look at my computer. Like I'll show them some like spreadsheets, some online marketing thing. Like the same like childhood experience that you're sharing with the kids.
You should have them host the next podcast episode.
Yeah. Well, my oldest is 4, so
That's awesome.
might be a little bit tricky. She will be ready yet one of these days.
That's awesome.
Fouad, you're awesome. Thank you for taking the time to kind of share like what you do, why you do it, and everything. If anybody listens to this and they're interested in getting in touch with you, what's the best way?
Instagram's probably the easiest. So at Fouad, my first name _ Airbnb, or LinkedIn, Fouad Bazzi's to the easiest way to do it.
All right. Fantastic. Well, thank you for taking your time to be here today. And for everybody else listening, I will see you next week.
Thanks, Brandon. Appreciate you.